Whole life insurance, good, bad, or ugly? Is it a great place to put your money, or is it a scam and should we run away from it? There's always one side or the other. It's interesting how that works, isn't it? The question is, why do some people think that whole life insurance is a scam? And you could be watching this and yelling at the screen, because it is! And then some people think that it is the best area to position money, period. Non-life insurance agents, by the way. I just want to make that clear when I make that statement. Why do some consumers feel run away from it, worst place ever to put your money, and then some consumers think, hey, this is the best area I could ever position my money. I love how it works, the returns, the safety, the liquidity, how I can access the money. Why are there two sides of the fence? Well, information, opinions, whatever it might be. So we're going to break this down and look at some actual examples here. We're going to break down the cash values, policies, good policies, bad policies, what the wealthy do, how commissions work. So let's have some fun. So with those two questions in mind, I'll let you know that we work with individuals. We set policies up for individuals that are putting in $1 million per year. And then at the same time, individuals that put away $10,000 per year. Maybe it's $5,000 per year. Depends on the individual's circumstances. But individuals that put away $1 million per year typically earn much more than $1 million per year, but they do very well for themselves. They have businesses, other investments. They're smart people. They've gotten to that level by making good decisions. Of course, they've learned as they've gone. I can say personally that I do not think I am a very smart or sophisticated investor by any means. However, I am experienced to a degree in business and continue to learn as I go. That's the most valuable lesson as time passes, experience and learning from your mistakes. But anyway, individuals that put away $1 million per year, why would they put it into whole life insurance? It's not because we're such a good company in terms of sales and I convinced them to do it. No, they did their due diligence, their vetting process. They consult with their attorneys, their planners, their CFOs, whoever it might be, and they make a decision to say, hey, this is a fit for you. And I'll let you know this, it is a focus on cash value. The death benefit has a long-term play, but it is 100% a cash value play. We work with banks. We set up a bank-owned life insurance policy about a month ago. Large deposits banks make, typically a one-time deposit, tons of money in the 8-figure range was the amount of the deposit. One we set up in 2020, another in 2021. Why do banks dump so much money into cash value life insurance? So the bank, being a consumer, think that whole life insurance or cash value life insurance is the best area to position money. These individuals that put away 7 figures per year, and if it's in the 6 figures, 5 figures, whatever our situation is, they all work the same. Actuaries we work with that understand the cash value life insurance policy will state, here is how to design a policy for maximum cash value. One actuary, in fact, that I am a big fan of is Scott Witt. We've had podcasts with him. He is a fee-only insurance advisor, serves as an actuary, and really he consults with individuals. He works really fee-for-service only, consults with individuals on how to design a policy for maximum cash value. And if we want to take it a step further from an actuarial perspective, how does cash value life insurance fit into everything else that we are working with? Our stocks, bonds, mutual funds. He's very, very good at that. But an actuary that owns cash value life insurance himself says, here is how to optimize it. That's exactly what we do from a policy design standpoint. And I'll let you know this, how those type of individuals that understand the product and really understand numbers, statistics, how they recommend designing the policies is how these guys design the policies when we work with them. So policy design is the key here. CFOs we work with at banks look at it and say, okay, this is great. We can't get enough money in these products. Attorneys that actually understand cash value life insurance love it. And what I like about some attorneys, one comes to mind in particular. She is extremely intelligent and knows what to look for. She knows tax law, but then at the same time, when it comes to life insurance policies, knowing how they should be designed, how MEC limitations work, how compensation works, having an attorney that knows what to look for is very, very valuable. So, point here. Why do some people think that whole life insurance is the best thing ever? These individuals do. Banks utilize it. Wealthy individuals utilize it. Individuals putting away $10,000, $100,000, $1 million per year, whatever it might be, it's all set up the same. A policy can be fantastic. But then at the same time, we hear that it is a ripoff. Stay away from it, run away. Buy term and invest the rest. You can make a much, much better return, be much more profitable on your money if you invest in the stock market and just buy term life insurance for your life insurance needs. That way, if you die over the next 20 or 30 years, you're covered. Simple, easy. Okay, makes sense. Whole life insurance pays ridiculously high commissions. Those agents are just going to rip you off. That can be true sometimes, but it is very, very important to understand how the commissions actually work. I'll let you know this. When you look at a policy that's designed for a bank or an individual putting away $1 million per year, those policies are designed for absolute minimum commissions, maximum cash value. Banks, same thing, maximum cash value, minimum commission. When we work with individuals, it's the exact same thing with someone putting away $10,000. So that compensation to an agent can be very high, can be very lucrative, but how that policy is designed and if the consumer has their money up front will directly impact the agent's commission. You'll regret it forever. Stay away from it. So why do we see two sides here? Two sides of the argument. Very, very good. And then, hey, it's a ripoff. Stay away from it. Well, a lot of information, a lot of opinions out there. Here's my advice. And this is with everything. This is actually a quote I heard from Jim Rohn. He's no longer alive. I think he died in 2009, but I love him as a business coach, business mentor. Do not be a follower, be a student. He was actually referring to reading books and taking in information. A lot of value out there, but don't be a follower, be a student. Same thing here with everything. I love that quote because it's very, very important. I'll let you know this. These guys, when we hear of the ultra wealthy, rich people, people with a ton of money putting it into whole life insurance, they typically are not followers. They are going to be a student of their business, of their finance. They're going to do their due diligence, or they're going to hire someone else to do it for them to make sure they are set up in the best possible position. And the thing is, anyone can do that. How do we copy the people that already have it figured out? Do some research. This way we can make sure it accommodates us, or you can reach out to us. We can set up any plan for you or work with you in educating on how it works, or really dig into it. Customize the policy. Take it several steps further if we want to understand how it works. So let's get into this a little bit. Let's specifically hit on this item because everyone has questions on this. How do commissions work? We've got videos that really break it down in thorough detail, but here we're going to give you a quick overview and then look at some samples of the different types of policies we mentioned, how banks use it, the ultra wealthy, and then the average Joe. So when we have a whole life insurance policy, here's the fun part. If you open a policy, your money can go toward one of two areas. I can pay it toward the insurance premium or toward what's called a PUA rider. This PUA rider immediately accelerates the cash value growth. So, for example, if I were to pay $10,000 toward the insurance premium component of a policy, in respect to your cash value, if I'm looking at a traditional old school whole life insurance product, I'm going to see zero show up in cash value, often the first and second year. The reason why? The company is going to overcharge me for the death benefit. This depends on my age. Let's say it purchases me $500,000 in actual life insurance. Okay, I paid in $10,000, nothing in cash value initially. Eventually it builds up, but takes a long time to see any real value. But I've got a healthy death benefit right off the bat. But when I say healthy, what you could look at there, all right, well, it cost me 10 grand to get that death benefit. I could pay $1,000 per year on a 20 or 30 year term policy and get the same $500,000, which is true. This item, this PUA rider, same $10,000. I pay it in. Guess what is in cash value? Just about $10,000. Day one, it might be $9,800 or something like that, but then begins to compound and gets better and better. Does purchase me some additional life insurance, but really, why people pay money toward this area is to grow this. Question we always get, I used to receive this question all the time when I would just design policies for individuals, is, hey Steve, I understand the two areas, premium or the PUA component. I'm not really concerned about the death benefit, or I don't care at all, to be frank. Not right now, at least. How do I put 0% of my money in the premium and everything else in the PUAs? Can't go quite that aggressive. Typically, we can go as low as 10% with the top companies. Now, with that said, these two areas is what I want to understand. Premium or the PUA in respect to compensation. So what you'll find in the first year, if I have a $10,000 premium, that might pay me, call it $9,000. It is going to fall between 85 to 90% with most of the top major mutual companies. If I select a smaller company, that could go all the way up to 130% in terms of compensation. Depends if the company solicits in the state of New York or not. But the first year, $9,000, and then I could see years 2 through 10, compensation might be $500 per year. So it is front-loaded, where it's very, very heavy up front. $9,000 year one, and then years 2 through 10 on that $10,000 base premium, $500 per year. Versus the PUA component. This will depend on the company as well, but what you will find in all years, that is typically going to range between 2 to 3% that the company will pay the agent a commission for the client or policyholder making that deposit. So that would be what? $200 to $300 per deposit. So as a consumer, if I'm a policyholder, where would I rather put my money? I'll let you know with my policies, I design them where I can throw a ton of money into this area, a PUA component to grow the cash value. As an agent, I am an agent, we drive our business through life insurance sales. What is the most profitable area for a client to pay toward? The premium. There we go. Much more profitable, especially up front. Now, I'm not saying that high base premiums automatically make an agent bad. No, everyone has to run a business, but here's my thing. If a high commission comes at the expense of a consumer, that's where I've got an issue with it. That should not be the case. In my opinion, from a business standpoint, every policy that's designed should always be in the client's best interest, show several options. If it's fully transparent, the client, the policyholder, can select the option they want, and then the agent is paid a commission. Whatever it is, if you do the right thing and you're fully transparent, it'll work out perfectly fine over time. And you'll have peace of mind where you don't have to worry about it coming back to bite you down the road. So let's take a look at some examples that we see over here. And we're going to look at some numbers here. Let's start with a bank. Everybody's always interested in how bank-owned life insurance works, because we hear that big banks, corporations position literally billions of dollars into cash value insurance, which is true. Here's a $10 million example. This was an actual case study or actual policy we set up earlier this year, set up with different companies here. What do we see? Total deposit, $10 million. We see it diversified with different companies. $10 million in, $10.2 million in cash value right off the bat. 24 million in death benefit initially. This is on 30 employees or officers, I should say. Now here's the thing on this. What banks can obtain is different than what you and I can obtain as an individual. So bank-owned life insurance is a bit of a different animal. It's not offered to the general public. The main attractive item that I wish was available to everyone is that positive cash value right off the bat with whole life insurance products with the major mutual companies. We see 3 of them here: Mass Mutual, Guardian, New York Life. The other one is Northwestern Mutual. Okay, so that is an example of a bank. Let's look at a high net worth individual. So we talked about individuals we work with that pay or put away $1 million per year into these policies. So if I'm on the other side of that, I hear someone say, hey, individuals pay $1 million per year into cash value life insurance products. Some pay a lot more than that. I hear that and think, okay, why? What is the reason an individual that already has it figured out, they've grown a business and they know what to do with their money, typically they are advised, the people we work with that put away that much have top tier advisors that vet the product before they move forward on it. So we see that firsthand. So again, if I'm a consumer, if I'm you watching this, my question would be, well, why would someone put $1 million per year in it? What is the benefit? Well, the benefit is as follows. If I look at a whole life insurance policy, core benefits are as follows: safe, liquid, tax-free area to position money. So safe, meaning in no way, shape, or form am I invested in the market, tied to the market, none of that stuff. I have a guaranteed floor, but no matter what happens, my cash value continues to appreciate. And especially right now, when I look at it compared to bank accounts, produces a much stronger growth rate on cash value. Oh, and by the way, if I don't trigger a MEC, if I don't trigger a taxable event, that is a tax-free return as well that we're going to look at here. Liquid, I can access the money very easily. 2 ways I can pull money out: through withdrawals and through loans. Typically loans are in one's best interest. We've got more info on that. And then the tax-free component. This is where a lot of wealthy individuals are attracted to it, because if I'm in a high tax bracket, having a tax-free yield does really help me out, and I'll show you here specifically. So option A, we see a $1 million payment up front and then $500,000 per year thereafter. They're not committed to this either, by the way. They can have a very flexible policy here where their minimum premium is, guess what? About $100,000 per year. So they can commit to that and throw up to $1 million per year. But look at the cash value day one, 97%. So we mimic as closely as possible what that big bank was doing. How do we optimize the cash value and squeeze the commission down as low as possible? Now, if we could design it where it's cash rich and commission rich, hey, if you get the best of both worlds, sign me up. But it doesn't work like that. As an insurance company, when you really look at it from their perspective, policyholder pays money into a product. Insurance company says, okay, we are going to pay a commission to the agent who is on this policy. We're paying them a commission for bringing us that business we otherwise would not have had. The more cash value that is in the policyholder's policy in cash value, the less money the insurance company can pay to the agent. I'm simplifying it quite a bit, but that's really, when you look at it, how it works. The higher the cash value, the lesser the commission. What's highlighted in yellow represents his break-even point. Annual IRR represents internal rate of return, what he's actually growing. So anytime you see a whole life insurance policy with a dividend rate, call it of 5%, 6%, whatever it might be, we always want to keep in mind that that dividend rate is a gross rate credited after the company's insurance expenses, after the company's mortality charges. I want the net internal rate of return, meaning, hey, at the end of the day, what did my money actually grow by, so I can track the performance over time? Here we go. Negative 3% year one. He's got a $23.5 million death benefit. That's the minimum death benefit in this particular policy. But there's my effective growth. Tops out, this is annual internal rate of return, not the average. Tops out a little over 5% if we were to scroll down. Taxable equivalent shows what he would have to earn elsewhere in a taxable account to net the same difference. Meaning, if I'm earning 8% in the market, taxes will be due in one way or another. So after I pay those taxes on the gains, what my actual return be on my money? With a life insurance policy, I do not have that because I've got the tax-free component associated with it. Then we've got a different option with a different product and different company, 95% right off the bat, breaking even just about year 3. There's my IRR over time, but he just front-loaded the policy up front, 5 years, has the option to continue to pay, but pays nothing in. Wanted to get $5 million in and just let it sit and grow. Okay? Get stronger and stronger over time. Not bad, but different options. Here's exactly how they're playing it. Safe money, fixed assets. I can reposition assets. I've got access to my capital. If I die, this death benefit is paid income tax-free from an estate planning standpoint and legacy standpoint. That provides a ton of value. So that is one angle, the wealthy play, that really anyone can play as well because we do have that large death benefit. Here's a sample on how high net worth individuals use it. Let's look at a $100,000 per year example. I've got a treat for you on this one. We're going to look at the commissions. This product has a top commission rate or compensation of 85% on the base premium, and the PUA commission is 3% per year. So on the left, we've got a traditional old school whole life insurance policy. 100% base premium, $100,000 per year for 10 years. He wanted to pay up until age 50. Here's his cash value. Remember, the company overcharges me in the first and second year. In this product, it's only the first year. 100,000 in, 3,300 to show for it. Breaking even between years 10 and 11. Talk to individuals over the years that have put away this amount of money, sometimes more, and a consistency I've seen, especially if it's 100 grand or more. People look at this, don't move forward with it. We don't try and sell it, but they tell me about it and say, okay, why would I do this? I'm interested in the cash value. That's why I reached out to someone to talk about whole life insurance. Why would I do it? I'm not seeing the value. There's other things I can do with my money during this time period. This cannot be what big banks and wealthy individuals do. Just doesn't make sense to me. Like, what's going on? That's something we hear and see consistently. I used to wonder that when I was new in the industry. I heard all these great things about banks doing it. I'm like, can I see what banks do? Because this looks different when I was brand new in the industry before I got into the designing role and really learned all the ins and outs. But here's what I want to touch on. This is 100% premium, 85% commission rate on premium in year 1. 85 grand is what an agent would make on this. Years 3 through 4, $10,000 per year, and then the renewal drops to 3%. If they continue to pay premiums, a reduced commission is paid, but we stopped it in 10 years in this example. So grand total, $133,000 paid to the agent over that 10-year period, compared to the same policy, same individual, same health rating, same company, same out-of-pocket 100 grand per year, but designing the policy much, much different. Now we've got a policy with a minimum premium. If we minimize the premium, what else do we minimize? Here's my commission year 1. Now granted, I am on opposite ends of the spectrum here. All insurance expense, insurance premium, minimum insurance expense or premium. We can look at middle of the road examples. We've got several case studies. I would encourage you to look at any of how commissions work, any videos with those topics on commissions. What does an agent or broker make in commission if you'd like that information, or just reach out to us anytime. We're always happy to talk. But we've got $100,000 that goes in, $88,000 in cash value with the same product granted compared to the $3,300. This is where the agent, the consumer to a degree, if they have the knowledge, but really the agent needs to make the consumer aware of this kind of stuff. If I purchased this policy, or even one with 50 or 60,000 right off the bat, and then found out that it could have been designed differently and that the agent's commission was impacted as well, that's where as a consumer, I'm going to start to think, okay, why didn't you tell me that? It could be a good guy, maybe they didn't know how to design it, but like you got to disclose the information up front or always make sure that we're designing it for maximum cash value. Because I hate if I do something and then after the fact, it makes it look like I did something wrong. Now, I'm not saying agents do that. That's not my intention here. Here we go. Years 3 and 4, I break even. Here's the compensation. Look at the difference. $40,000 compared to $133,000, in which the client deposited a total of $1 million. Okay, so over 10 years, 40 grand in commissions, that's not bad at all. Here's really what I want to look at though. If you can make the same 130 and it did not impact the client's performance at all, would it be okay? Yeah, I see nothing wrong with that at all. If it did not impact the client's cash value performance. That's the big thing. On the far right, cash value difference. Year 1, it's about an $85,000 difference, just so happens to be the amount of the commission. That's the difference in cash value, meaning the client has $85,000 more in cash value. Same dividend rate assumption all the way through here. Like we always show when we pull this data directly from the insurance company software. Look at this over time. Not paying anything in after year 10, so the commissions stop at that point in time, but look at the difference in value. When he is 65 years old, if he wants to begin to pull income from this, 2.1 million compared to 2.65 million, a $540,000 difference because we designed the policy differently from the get-go. Like that's incredible, all by designing the policy properly. So this is where it's very, very valuable to understand how a policy should be designed, but really going back to the original question, right? Some people think that whole life insurance is the best thing since sliced bread, and then some people think it is horrible, run away from it. Why are there just polar opposites? Here's a great demonstration. High cash value, low cash value. What did the compensation look like? That stuff has to be told up, be showed up front. Don't hide it, don't play games. And I'm showing all these big numbers. And sometimes we're told, hey Steve, can you show some normal numbers or lower numbers? And yes, I'm sorry that I always show the big numbers. I'm just used to it from doing it forever. So here's a case study with $10,000 per year going into a policy, a 100% premium, nothing into PUAs. Look at the pattern here. 10,000 in, 1,100 right off the bat. Breaking even between years 13 and 14. That's a long time. Here's a policy where the individual decided to pay 50% of his payment toward the premium and the other 50% toward the PUA component. As a result, see a little more than half of his payment show up in cash value, breaks even year 9. So much, much better than the first guy, but when I compare it to the example on the far right, 10% premium, same out of pocket, same company, breaking even year 5. Let's look at this long term. There we go. Stop this one after 30 years, but that's okay. That tells us all we need to know. $437 on the all base premium, $479 on the 50/50, and just about $500 on the 1090 with the same company, same product, same out of pocket, but different design. So interesting, isn't it, when you really start to break this down? So a lot of info here to sum up the questions or to answer the questions. Why do some people think that whole life insurance is a ripoff? Well, what we found to be consistent is that crowd are typically individuals that have been pitched on whole life insurance products that look like those traditional policies, nothing up front, or they saw one that had 50, 60, maybe 70% of their money up front, but it took 7 years, 9 years to get it back, and they're looking at it and saying, it's not doing the thing that it needs to do for me. And then the people that think it's the best thing are those individuals that put a lot of money there, where they see the value immediately, they see the value long term. It's designed for maximum cash value. The design. I hate throwing in, hey, here's how to design a policy. I mention it all the time, and sometimes it's a bit technical because it makes it sound like the consumer has to do some work in designing it. Shouldn't have to. The agent really should be doing that, whether you want it designed for maximum cash value and just kind of see it on the surface, or if you just want to, or I should say, if you really want to dig into it and design it with the agent, that is possible as well. So I know I went through this one quickly. I got a bit excited. I've had a lot of coffee today. If you have any questions, feel free to reach out anytime. Would love to connect with you. We do run our business and operate it ultimately by selling policies, but I will let you know, first and foremost, our mission statement in it is transparency and convenience. We're always aiming to improve both, but transparency comes first. How do we provide all of the information with different companies, products, and such? We would do the same for you or anyone we work with. So I do hope this helps. Reach out if you have any questions, and I'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.